The worst investment strategy you can possibly have is anticipation, because whatever you anticipate, I can promise you, markets are cruel. It's not going to happen the way you think it's going to play out. That's why you've got to have a strategy that's based on your goals, that's based on anything that happens, you're prepared, because we just don't know what the future is going to look like. If we did, we'd be on our yacht.
You know, most important thing is, you know, Rye, you're right. It's just been a small correction. It's just starting, pullback. We haven't seen a pullback in 2 years. So people think, wow, this is not normal. The worst thing you can do as an investor is panic and sell everything. Say, I'm not taking any chances, because the biggest problem with that is you'll never get back in. And this economy has been resilient. We've been telling you for the last 3 years, we're not going to have a recession. The economy is resilient. We're going to keep betting on the resilience of the economy. The key here is not to panic, is to stop being a trader, stop thinking as a momentum investor, and go back to being a long-term investor.
And it's just like everyone who is so bullish all of a sudden has become so bearish. And as you like to say, Bob, that's why it's so hard to invest.
Yeah, it is. But I'll tell you what, I love these huge down days, because then I can get my calculator up. And I can tell you right now, if you have 700-point down days, it only takes 61 days for us to get to zero on the Dow. And I'll tell you what, that will be the buying opportunity of your lifetime.
Because you get to own all those physical assets, right? Contrary to popular belief, stocks just aren't paper.
You know, I always wanted that jet, Rye. I want the Madison Square Garden, and I want a jet. So this is our opportunity. So sell, sell, sell. But we're, markets never go to zero. And I think that's one thing investors don't ever get into their head, that markets go down, but they always recover.
Yeah, I think what's really interesting is when you look at the sentiment levels, so you actually track these weekly and you send these to all the advisors, but the AAII investor sentiment levels are at, how low are they? They're at
19%. It's abysmal. It's
yes.
like as low as it's been in the last couple of years.
Exactly.
Yeah.
And I think what tends to happen is you tend to still have that euphoria of people buying in, but right now you have everybody just ready to push on the sell button, which almost as a contrarian makes you think this probably is a buying opportunity and not something to run away from, right?
I think it's the old proverbial be greedy when others are fearful. And I think right now, more than ever, it's like the dynamics, and we said this a couple weeks ago, of the economy really haven't changed that much just in a couple of weeks.
Well, it hasn't, because, we look at literally hundreds of portfolios that we don't manage, right? People who are bringing their money to us for us to consider managing. And the majority of the accounts that are run by people that run their own money or run by other advisors have been so overweighted in equities, so overweighted in the highest risk investments. And the thing that really blows our mind is, number one, people expect 20% annualized returns. And secondly, they think corrections will be like 5 to 10%, that there's no way that this high risk leverage strategy they're following could go down 50, 60, 70%.
Well, that's a great point. I mean, we always go by our most recent experience, and let's face it, we haven't had that many significant sell-offs. Even during the pandemic, the market was down 20%, or the S&P was. That's not the same as the 50 to 60% drawdowns we saw during the great financial crisis or when the dot-com bubble burst. And to your point, Bob, right, there's this like crazy belief right now that you should get higher than historical returns on the upside, and your downside should be more limited, which we know is just ridiculous.
Yeah, and I think something that shouldn't get lost with all of the headlines right now and how much the S&P or the Dow is down is not everything is down, right? Like even yesterday, markets were down a few hundred points, but you had things like real estate, utilities were actually up. We've been talking about this year, but Europe has actually outperformed the US. China is up today, even with the S&P 500 being down. And I think we get caught up in these headlines and what the US is doing, and especially when Trump has all this America first rhetoric that he talks about, we forget about the rest of the world, which is still doing great. And, that's why we want to be a diversified investor, is because a lot of our clients' portfolios are still up for the year, even though the S&P is flat.
Well, you're missing one big asset class, Court, bonds, right? The interest rates are down. Bond values are up, whether it's treasury bond or a corporate bond or a municipal bond. And the beauty of bonds, when you have a balanced portfolio, is number one, when rates go down, they go up in value. And if the market gets to a point where it's just going to become a phenomenal buy, if you don't have any bonds in your portfolio, you don't have any fresh cash to invest. You're just sitting there watching your portfolio go down.
Yeah, no. I think it also speaks to just the irony of investing, right? Who would have guessed? We said this before, but like China would be up, Europe would be up, given the fact that we have this American first policy going on, you would think it would be the opposite, but the dollar is weakening. Interest rates have come down a lot, which has pushed our bond prices up. I think this is just like textbook why you diversify, because when things change, it's going to be completely unexpected, and it's going to be in a way you wouldn't have factored in ahead of time. Like nobody was calling for the situation we're in right now. So it just comes down to always having your bases covered. And to your point, like we look at so many portfolios, nobody's been prepared for this. Maybe we have, not to sound Pollyannish, but this is why our diversification works.
And I think this is just a good example of why this is time tested, right? Like I think if you looked over last year, there was a lot of headlines on the media saying, oh, is the 60-40 portfolio dead? Like that was a constant conversation people were having. You also saw people were saying China's uninvestable. Like people just start to throw it out the window and say, you just want to own the Magnificent Seven, just these 7 companies. That's all you need to do and you can retire. And that's just not the case. And that's what we've been arguing for a long time. But things are going to shift, and they are shifting. This is why you have to make those changes to be diversified even before, when it didn't look like, anything other than those 7 companies were going to be your best performers.
Well, and the other thing is this has been a very small correction. That's the other part of it, is people get so skittish so quickly, right? Everybody thinks when the market's going up, I can handle a 10% drawdown, 15% drawdown. We're not even talking about a 10% drawdown right now. If you look at it, most markets are off a couple of percentage points, and people are running around like their hair's on fire. So never mind. And look, we've got the scars on our back to prove it. We've been through some 50, 60% corrections. Like that is really scary, but nobody thinks about that when the times are good. And again, just a small correction, and all of a sudden people are just like freaking out. It's crazy.
Yeah, but it is amazing when you see how quickly greed turns to fear, how quickly, exuberance turns to despair. And everybody just focuses on the negative headlines as opposed to, well, oil's going down. That's a tax cut for every, and consumer, every company in the world. Interest rates are going down, right? That's a bonus for every company, every investor in the world, right? Earnings just finished a quarter where they're only supposed to go up 8%. They went up 14%. And the quarter's just ending. It's like, oh no, the world's ending now. Forget about all this good news. We want to focus on all the bad news. And really, all it is just the uncertainty of what's going to happen tomorrow.
No, it's a great point, because if you just zoom out a little bit, the big picture really hasn't changed, right? And if you look at the employment market, still very strong. People have jobs. Wages are going up over inflation. Inflation's come down a lot over the last couple of years. So like the big trend hasn't changed at all, but it's like these short-term hiccups and uncertainty, Bob, like you said, all of a sudden derail people's complete investment game plan. That shouldn't be the case. You got to keep your eye on the prize. And I think, that's what we've done, I think, really well, is we've constantly looked at that big macro picture. And from where we're standing, it kind of looks the same right now, just as good as it's looked when everyone was screaming about recession for the last couple of years, and it didn't come to fruition. I suspect it's going to be the same outcome this time around too. The smoke's going to clear, and it's going to be, wait a second, what was everybody so worried about?